6 best high dividend paying stocks to buy under $10. Are you missing out on high yields hiding in plain sight? With inflation on the rise and savings accounts paying paltry returns, seeking out undiscovered income opportunities, trading for less than $10 per share takes on added importance. What if I told you that by investing small sums in just a select few overlooked companies, you could generate market-beating dividend payouts with the power to substantially boost your portfolio's bottom line? So, whether you have a few extra dollars to put to work or are seeking to supercharge an existing portfolio, we are here to help. Let's dive in. Number 1 on the list is Banco Santander, SAN. Banco Santander is a global banking giant based in Spain with significant operations throughout Europe and Latin America. The stock currently, as of March 2024, trades around $2.60 per share and offers a high dividend yield of over 8%. Historically, Santander has demonstrated a consistent track record of dividend payouts, having paid shareholders every year for over a decade. The company has also gradually increased its base dividend amount during this time, providing rising income for investors. However, Santander's stock price has been more volatile over the long term. It reached over $5 per share in 2015 before dropping sharply before $2 at the onset of the pandemic in 2020 as economic uncertainty rose. As one of the largest banks in the world by assets of over $1.7 trillion, Santander benefits from a highly diversified business model spanning 10 core countries. Still, the stock inherently carries more risk than some due to its exposure to economic swings in Europe, as well as emerging markets where it has a growing presence. Looking ahead, Santander is undertaking a strategic transformation to focus on digitalization and efficiency. If successfully executed, this could help drive stronger profitability and returns over the coming years. Overall, Santander's stock offers an attractive dividend yield of over 8% at current prices. For investors with a long-term horizon, the company shows a proven track record of dividend payouts that could continue rewarding shareholders. Number 2. Kinross Gold Corporation, KGC. Kinross Gold is a senior gold mining company with a global portfolio of mines and projects located throughout the Americas, West Africa, and Russia. The stock currently, as of March 2024, trades around $3.50 per share and provides a dividend yield above 4%. Historically, Kinross has maintained consistent dividend payments to shareholders since initiating payouts in 2005 through periods of commodity price volatility. However, its share price performance has followed the fluctuations of gold prices more closely over the long run. For example, KGC shares reached over $10 in 2011 when gold peaked, but then fell below $3 in 2015 as gold declined. More recently, the stock rebounded to over $7 in 2020 during the initial pandemic-driven rally in safe havens like gold before pulling back since. As a gold producer, Kinross's profitability is directly tied to the market price for the yellow metal, which can experience boom and bust cycles. Still, the company has demonstrated an ability to sustain its dividend through different commodity environments due to its large portfolio of long-life, low-cost assets. Going forward, risks include geopolitical instability, inflation levels, and COVID-19 impacts on global growth. However, Kinross also offers leverage to any potential rises in gold demand as a store of value or hedge against inflation. For investors seeking both income and commodity exposure, the stock's current yield of over 4% could make it a viable consideration. Number 3. Nordic American Tankers, NAT. Nordic American Tankers operates in the international seaborne transportation of crude oil and petroleum products. The stock trades under $3 currently and offers a substantial dividend yield over 8%. Historically, NAT has paid dividends consistently for many years, including during the pandemic downturn. However, its stock price has been much more volatile, rising above $6 in 2013 before plummeting before $1 in 2016. NAT recovered to over $4 in 2021, but has pulled back again, As a tanker company, NAT's fortunes rise and fall with oil shipping rates, which tend to fluctuate wildly. Still, it has proven able to maintain dividend payouts through the cycles. For investors seeking a high-yield opportunity in energy, NAT warrants consideration if its risk can be tolerated. Number 4. Barclays PLC, BCS. Barclays is a major global bank based in London. The stock currently trades around $7 and offers an attractive dividend yield of over 5%. Historically, Barclays has maintained a consistent track record of dividend payouts, having distributed shareholder returns each year dating back to the late 1990s. However, its share price performance has been more volatile over this period. During the depths of the 2008 global financial crisis, when many banks struggled, BCS shares plunged below the $3 level as market conditions deteriorated. More recently, the onset of the COVID-19 pandemic in early 2020 also pressured the stock, causing it to drop under $2. Since then, Barclays' share price has recovered along with the broader economic recovery. As one of Europe's largest banks by assets, Barclays' business covers multiple segments including corporate and investment banking, wealth management, credit cards, and trade finance. These diversified operations generate substantial recurring fee income and interest revenues. Even during economic downturns, the scale of Barclays' franchise allows it to maintain relatively stable earnings that continue supporting dividend payouts. That said, periods of heightened market stress or recession can still weigh on short-term financial results. Barclays also continues executing a multi-year strategic transformation aimed at simplifying operations and reducing costs. This should make the bank more efficient and profitable over the long run to further reinforce the sustainability of its shareholder distributions. Number 5. Telefonica SA, TEF. Telefonica is a Spanish telecommunications heavyweight with mobile and broadband networks spanning Europe and Latin America. The stock currently exchanges hands around the $3.75 price level while offering an outsized dividend yield above 8%. Like Barclays, Telefonica has proven its commitment to dividend payments for over a decade, consistently distributing returns to investors each year. However, its share price performance has followed a bumpier trajectory. At the worst of the 2008 financial crisis, TEF shares plummeted below $9 per share as macroeconomic and industry headwinds mounted. More recently, in early 2020, the stock fell under $5 amidst the broader market rout triggered by the COVID-19 pandemic. As an essential connectivity provider, Telefonica's operations generate fairly resilient cash flows even during recessionary periods or times of macroeconomic uncertainty. Its wide geographic footprint across both developed European markets as well as higher-growth Latin American nations helps balance risks. While short-term challenges may occasionally emerge, Telefonica's extensive network infrastructure and scale position it well to continue meeting dividend commitments. The company is also advancing network upgrade initiatives and digital transformation efforts to fuel service revenue expansion beyond traditional telecom services. If successful, these strategies could underpin long-term shareholder value creation in addition to supporting Telefonica's high dividend yield opportunity. Number 6. HiMax Technologies, HiMX. HiMax Technologies is a fabless semiconductor company trading around $6 per share. It has a market-leading position in the design and manufacturing of display drivers for small and medium-sized LCD panels. While growth has been volatile, HiMax has paid a reliable dividend for several years, currently yielding over 6%. Historically, HiMX shares experience strong gains during periods of increased demand for panels used in devices such as smartphones and laptops. However, the stock plummeted to below $3 during the 2015 industry downturn. Since then, HiMax has stabilized its business through diversification into newer areas such as automotive and IoT displays. Looking ahead, further adoption of these emerging technologies could drive renewed growth and share price appreciation for HiMax. For investors seeking a relatively undiscovered, high-yield play in the semiconductor industry, HiMax offers an attractive dividend yield with upside potential. And that's a wrap on the 6 best high-dividend-paying stocks to pick up now. While their stock prices have experienced volatility at times, focusing on each company's fundamentals, business strategy, and dividend track record can help assess their viability as long-term holdings. Most importantly, revisiting the key criteria of strong dividend yield and share price under $10 reminds us of the objective in researching attractive and affordable income stocks. Investing in quality companies with proven payouts may reward patient investors over the long run. Please note that we are not financial advisors, so kindly do your research before investing in any of the stocks we discussed above. Like, subscribe, and share the video if you found this useful. Post your comments on stocks that, in your opinion, are below $10 or you are currently investing in. Thanks for watching.